Hello everyone, welcome to a brand new video. Today, we're going to discuss whether the US is in a recession or not. But first, if you haven't done so already, please make sure to like and subscribe to our channel. Concerns that the US economy could be heading into a recession intensified after official figures released on July 28th, which showed that the US economy shrank for the second straight quarter, just days after the International Monetary Fund, or IMF, forecast a global recession. Pierre-Olivier Groinches, the economic counselor and director of research for the IMF, cites the pandemic and ongoing war in Ukraine as the main reasons for the increasingly gloomy and uncertain outlook of the global economy. The US economy shrank at an annual rate of 0.9% from April through June, the Bureau of Economic Analysis estimates on July 28th of 2022. It follows a contraction in the gross domestic product of 1.6% recorded in the first quarter of the year. As for some of the even more negative news, investment in residential housing and property declined by 14%, which makes sense given how much it had been rising since the pandemic upended the housing market. In addition, a drop in private inventory investment, a measure of how much stuff companies have produced but haven't yet sold, had perhaps the biggest impact on negative second quarter figures. While inventory reductions can be a sign of strength from selling products, the decline reduced overall GDP by over 2 percentage points. And overall, it means the US economy technically has shrunk for 2 consecutive quarters, which is why you're seeing a lot more economists, journalists, and others use the dreaded R word, recession. While economists agree that we are not currently in a recession for the most part, the outlook is far from rosy. A survey of 49 prominent US macroeconomists conducted by the Financial Times and the Initiative on Global Markets found that more than 2/3 believe a recession will hit fast in 2023. Experts generally agree that it is difficult to predict if, when, and how long a recession will last, with so many conflicting factors at play in the economy. It is believed that there's even a possibility we could avoid a recession altogether because of the strong labor market. Unemployment rates in June remained at a low of 3.6%. The same percentage it had been in the previous 3 months. And US job openings also remain high, with nearly 1.9 jobs available for every unemployed person in May, Bloomberg reports. Facebook's owner Meta, one of the largest publicly traded companies in the US, and Twitter are amongst companies that have announced hiring freezes that may seem concerning, but this is not entirely bad news. Recessions are also marked by widespread layoffs and a significant rise in the unemployment rate. Unemployment insurance claims are a good real-time measure, economists say, since the federal government releases new data weekly. If more people are filing for unemployment benefits, that could be an indicator that the labor market is starting to slow. By this standard, things don't look as bad. The labor market is still adding jobs, and jobless claims aren't spiking. Many economists also point to the SOM rule, which measures whether the unemployment rate has increased sharply. The rule holds that a recession is triggered once the 3-month average unemployment rate rises half a percentage point above its low over the past 12 months. The current national unemployment rate of 3.6% is as low as it's been in the past year. So the SOM rule would have to be triggered if the 3-month average rose to 4.1%. The rule was created by Claudia Song, a former Fed economist who said the United States isn't in a recession right now by this hyper-specific measure. While the 2-quarter rule does hold precedent, there has never been a recent major recession that was declared without a subsequent loss of employment. Jobs are being added in the United States by hundreds of thousands monthly. Wages are up, and labor demand is still strong. I do not think the US is currently in a recession, Powell said at a news conference on Wednesday. Now, the pace of job growth will likely slow, but there would need to be a sharp reversal for the current path to turn into one that looks like a major recession. Economists also pointed to the weaknesses in personal consumption as evidence of a slowdown. While the first quarter contraction seemed driven by one-off changes in things like imports, the second quarter report pointed more directly to developing weaknesses in the US economy. On one hand, gross domestic product, a key measure of economic output, shrank for the second straight quarter this week, raising fears that the country has entered or will soon enter recession territory. On the other hand, the job market remains strong, telling us that according to labor, the economy is still robust. But most economists do call 2 consecutive quarters of contraction a technical recession, and with good reason. 10 out of the last 10 times the US economy shrank for 2 consecutive quarters, the US economy was declared to be in a recession. So according to this definition, we are currently in recession territory. But massive job losses occurred during 7 out of the past 7 recessions, and we're just barely seeing signs of that now. The labor market has remained a source of strength for the economy and the sole shining beacon of hope amongst those who believe that the US can still avoid a recession. As of June, 98% of jobs lost during the pandemic have been recovered. Unemployment has remained at its historic lows in 2022, and the US economy has added 2.2 million jobs since January, nearly the fastest growth in recent record. In May, there were about 2 open positions for every job seeker, along with historically low levels of layoffs. The economy is creating almost 400,000 jobs a month, and paychecks in June were also growing. That doesn't look like a normal recession. People are definitely unhappy with inflation though, which at 8.3% has recently been running its highest since 1982. But inflation alone is not a recession, which is defined as a significant decline in economic activity. Economic activity is not falling according to the labor market. On the contrary, jobs are growing. The most important criterion is whether the national output has fallen. GDP has risen since the start of 2021 at 4% per annum, averaging over 5 quarters. The market for goods and services is increasing. The NBER also looks at the second measure of national output, called gross domestic income. The most recent data indicate that output rose slightly in the first quarter of 2022. There is no reason to think that that growth is now turning negative. Indeed, in this way, domestic demand for jobs has continued strong, making it likely that the expansion will continue into the second quarter. At least we hope. That's it for today's video. If you enjoyed it, please make sure to like and subscribe to Finance and Tech News.